Robschild. No investment advice. Welcome to the show where we view financial markets through crystal ball gazing. JP Morgan once said millionaires don't need astrologers, but billionaires do, and so we begin. Sorry about missing last Friday's show. Today is Monday, August 12th, 2024. There wasn't much to report on Friday anyway, so I will not be giving a Friday update. We're just going to skip to today. On today's episode, I wanted to do just a short little note on risk tolerance and active investing. You know, obviously, if you're watching this show, you probably are, being an active investor. You don't just have S&P 500 for 60% of your portfolio and 40% in bonds or something like that. You're probably trying to, get an advantage in markets, figure out what is going to increase in price, how you are going to maximize the assets and money that you have to, take the most advantage that you think you can get. And that's great. Most people that try to do this don't do very well. Benjamin Graham, in his book Security Analysis and the Intelligent Investor, talks about famously how a lot of times doctors, in particular, tend to become active investors because they can afford it. They have a lot of income and wealth that they can, play around with and not worry about if they don't do so well. And he says how infamously terrible they are at active investing. And history shows certainly the average retail investor that tries to get any kind of edge in markets typically fails miserably. And, and the smart money wins and the poor or the dumb money loses, so to speak. But that viewpoint is always in retrospect. But besides all of that, the main points I wanted to talk about on risk tolerance is that there's one golden rule that I like to think about that I think is the most helpful golden rule for any kind of active investing, and that is to always assume that you are completely wrong, and then ask yourself, is it okay? Am I going to be okay if I'm completely wrong about this? If you've been watching my show, you know that one of my big standpoints right now is I think interest rates are headed much lower. I think the value of most assets are headed lower, especially stocks in particular. And therefore, the value of treasury bonds is probably the best place to be right now. Now, with this idea in mind, I do assume that I'm wrong. I think in my head, like, okay, so let's say we get this soft landing, which I don't believe, but let's say, just imagine it's happening. We get the soft landing, the economy is booming, rates are going down, business is going up, inflation starts to increase, so therefore the value of businesses goes up, stocks continue to go higher, and the value of treasury bonds actually collapses because rates go up. I don't believe that that's what's happening, but am I okay with that happening? I'm going to say yes, partly because I have more than 25% of my portfolio in stocks that, especially stock areas that I think that would, get a huge advantage if that were to occur. Particularly with Chinese, and Brazilian stocks, along with a select number of other stocks that, as long as everything's fine, my stock positions should do extremely well. Now, notably, I only have 25% in there, and so I don't expect them to do well. I expect the bonds to do well here, but I assume that, my idea is wrong. I even invest that way. I'm investing assuming that I'm wrong here with 25% of my portfolio, and it's all okay. I'm okay with my positioning. If things don't go my way, I'll live another day. And so the point being here is that I believe that never advise on any of this, but I believe myself a great golden rule for any kind of active investing is just start with a premise, assume that you're completely wrong, and say to yourself, is this okay? If it's not okay, then maybe you're not in the right thing. Moving on to talking about the markets today specifically. Oh, this says next. Let's get rid of that. Tuesday, Wednesday, I had it backwards last week, by the way. PPI actually comes out first this week. I had it the other way because I'm so used to CPI always coming out a day before PPI. This time it's backwards. It just means the producers, how much inflation are producers experiencing first, and then we get to see the consumers. How much inflation are the consumers facing? And the consumer, the CPI, is the more important one when it comes to what's going on with inflation, because that's the price that people are actually paying for goods and services. That comes out Wednesday. These numbers could potentially rock markets. Like I'm saying, we're in very dangerous times. I believe, and the VIX futures curve believes, that the market is on fire right now. The Japanese yen carry trade that almost blew up the market, that they said, oh, no, they called, cried uncle or whatever, and the central bank was like, okay, we're not gonna, don't worry guys, and the market's like blissfully going up again as if like nothing's wrong here. Like, again, I'm going to repeat this. Just think about how terrible it is that the United States stock market was in an absolute crash. It was looking like an absolute crash because of the fact that the Japanese central bank was going to raise the rates by 0.25%. It just gives so much credit to Jeff Snyder's work in the Eurodollar University and all of his what he talks about all the time about how unbelievably delicate the whole system is, how fragile it is for that to occur. And it's scary, especially again with PE ratios being this high where we are in the cycle. We're now at the part where we're easing and assuming the Fed's behind the curve like they usually are. It's fully expected by me again. We're either in a recession or it's coming. It'll become more and more evident, I believe, as time goes on. It's happening now. It's no longer like a year away. It's like it's now. The SOM rule has been triggered. That says the recession has started, and we're starting to go more and more towards uninversion of the yield curve inversion. For a yield curve to be inverted, that's not a good thing. That's not a normal thing. When you lend your money to someone, for a longer period of time, you expect a higher payment, not a lower payment. The fact that it's been inverted says that there is trouble ahead, and the fact that it's been inverted for 2 entire years, the longest period pretty much ever in history, says that, this is, the alarm bell could not be louder here. One other thing, if you've been watching people saying the stock market's going to crash, going to crash, and you've been following markets in the news and all of that, you might feel immune to it. You might feel, oh, well, people have been saying this forever, and then nobody really knows if they're right or not. That is one way of looking at it, and that is sort of correct. However, I just want to bring up the illustration of the boy who cried wolf. Yes, when the boy cries wolf, 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 the villagers come, there's no wolf. He does it again, Then the 4th time or 3rd time or whatever, 5th time, he cries wolf because there is a wolf, and nobody comes. And then the wolf eats all of the sheep and the kid. Well, okay, we get it. Don't cry wolf. But one part of this story that people tend to forget is that the wolf eventually comes. The wolf is here. I'm not kidding this time. I know, 2 years for the yield curve to be inverted. This is highly unusual. This is why the market and so many people have been crying wolf for so long. We've been waiting for the villagers to give up. We've been waiting to kill the bears. I think the bears are almost done. I think the narrative is starting to flip more and more towards luring the retailer into this comfortable silence of, oh no, everything's fine. Are you kidding me? I don't think it's fine. The Fed starts cutting in September. It's 50-50 whether or not it's one cut or two cuts. Almost never is the first cut two cuts. It's almost always one cut. So we'll see how that goes. Let's get through some charts. So starting with the S&P 500, again, this is a great trend line here. Very powerful, high to high, dragging this so that it's parallel, so it goes low to low. From this low here, we bounced on it. It was clearly there. Investors clearly know about this line very, very clearly. We broke through it, and we've been creeping up towards it. A lot of very smart money, in my strong opinion, shorted today on the S&P 500. This is a very, very powerful line, and we hit it today, literally today. I fully expect this to turn over. Whether CPI and PPI come out to be very high or very low, I think the institutions are going to do a rug pull here, and I don't think they're going to care if it's high or low, because the excuse will be the same, right? If it's too low, if inflation seems too low, well, that means the economy is slowing down, and that means the whole economy, everything's falling apart. If it's too high, then people are going to say, oh, well, they're not even going to cut rates, because inflation is too high, and that'll also crash markets. There's no good news right now as far as what could possibly happen in my strong estimation. But that's just me and my crystal ball. This is a formidable line. We hit it literally today. I expect very strongly that we will reject off of it and head lower from here. Moving on to the VIX. Again, this is not supposed to look like this. This is supposed to be low on the left side and high on the right side. Instead, we are crazily inverted. Interestingly, as well, the November is now above the December, which is a little bit scary. It kind of indicates that right now the market is pricing pretty bad volatility, a pretty big sell-off right now, from right now through November, and that it won't start to get better until December. I had announced on my personal social media on August 1st, the day before things started to really go down, the bear market begins, and I think that's going to age very well. But, again, me and my crystal ball. Here's the VIX, and as you can see, I had been talking about this green candle here being all of these these candles after the giant green candle being inside days. It was up until Friday. Friday actually did crack below this one, and so there's a little bit more calm going on. We're not directly headed into another major spike, but I fully expect more bigger spikes to happen very, very soon in the very near future. TLT I only bring up because it's my favorite position, and I have 55% of my own portfolio in this. I had been talking about, I think it could go down to this line. We never made it down to this line, and so I think we can still easily get to this line. I think the market kind of needs to get to this line for most buyers to come in. I will be adding to this position if we get down here, especially. I've been talking about potentially adding more than 55%, depending on how things go. I might go to a full 75% in something like ZROZ, which has a little more duration than TLT, so it's a little more sensitive to the interest rate changes. Very soon, depends on a little bit on data, a little bit on especially like the unemployment rate. Like, I kind of want to see one more like tick up, and then I'll be even more confident that the wolf is here and currently about to eat me. Well, eat the stock market, I guess, rather. But meanwhile, HYT, always keeping my eye on high yield corporate junk bonds, as they're called. This is higher risky debt of companies. They pay a lot higher dividend, and they're a lot riskier. And the spread right now is really, it's back. It spread out, and now it's like an accordion. We went back to like, oh no, nothing's gonna go bankrupt here. So, I guess the dumbest of the smartest money, the junk bond market, is still not. It's just amazing. Last Monday, looking like we were falling off of a cliff, and then back to normal. Just think of it. This happened in April, and then it just happened this past week. So when's the next one? I guess we'll see. Fed funds futures is now pricing, according to investing.com anyway, exactly 50%. When the yen carry trade blew up, this had flipped strongly to saying, nope, this is an emergency. They're gonna, the stock markets are having a hissy fit, so the Fed's going to come out and give us 2 cuts for sure. We know that's going to happen. It's like 80% or something. So now we're back to 50-50 between 1 cut and 2 cuts. So there is a cut. The cut is here. It's happening, and it's always behind. And so the way I see it is, we can literally see the wolf in the woods right now, coming towards us. And I guess I'm not the only person to see this, as the Fear and Greed Index on CNN Business is still in extreme fear mode. That's all for today's show. Hope you enjoyed. Thank you for watching. Robschild.